Welcome to American Greed Fraud Prevention Strategies. I'm Jessica Hollobaugh. I'm a partner in Withum's Forensic and Valuation Services Group and the market leader of our forensic investigation and white collar crime team. I have about 20 years of public accounting experience, all here at Withum, ranging from an auditor and tax preparer in my early days to where I am today in our forensic and investigation team. My expertise centers around forensic and fraud investigations, and I am generally engaged by company counsel or defense attorneys, but we've also been engaged by the United States Department of Justice to assist them with their investigations as well. So the knowledge and expertise that I and the team here bring are kind of a collective effort from all sides of the table. I am joined here today by Justin Sachs, who is a senior manager within our forensic investigation practice and who I work with quite frequently on many of these engagements. So I'm going to kick it over to Justin just to do a brief introduction of himself, and then we'll go ahead and get started.
Yes, thank you, Jessica. As Jessica said, my name is Justin Sachs. I am a senior manager here at Withum. I have about 10, 11 years in investigation, white collar investigation, fraud investigation experience. And as Jessica mentioned, it's pretty much most of what I work on here at Withum.
Thanks, Justin. So today, and I promise you it's going to be a bit more interesting than it appears based on these learning objectives that are on the slide right now. But to start off, we're going to quickly walk through what occupational or workplace fraud is, and then the three main factors that kind of work together to create that perfect storm for this type of fraud. Then we're going to kind of dig into some case studies, and we're going to walk through two different engagements that Justin and I and our team have tackled this year. We'll fill you in kind of on what the background and what the allegations were, what our investigative techniques to respond to those allegations were, and then ultimately what we found from our investigation. And then after we get through that, we're going to quickly recap. We'll talk about some of the internal control failures that existed at these companies and kind of contributed to the opportunity for those frauds, and then quickly touch base on some prevention strategies that companies can employ. So Justin, if you want to take over and just talk a little bit about the fraud triangle.
Sure. Thank you, Jessica. So to kick it off, before we talk about the fraud triangle, we need to first define occupational fraud. So occupational fraud is fraud that is committed by an individual against the organization that employs them. And there are two key reasons why this type of fraud is so prevalent in the industries across various different industries. An organization with employees must, to some extent, entrust those employees to have control over its assets, to have access to their bank accounts, things of that nature. And it's very important that the employer can trust that the employee is doing the right thing when it comes to their assets. There are, according to the Association of Certified Fraud Examiners, the ACFE for short, there are about 3.3 billion people in the global workforce. And believe it or not, a large percentage of those people do act, do commit, do orchestrate schemes against their organization. But a large percentage of those people obviously do not. So it's important to understand the red flags and the reasons behind why people commit the things that they do. The fraud triangle is a way to approach occupational fraud, to understand that if all three of these prongs of the triangle or all three sides of the triangle are present, occupational fraud is more likely to occur in your organization. So the first side of it is the financial pressure. So this is the employee's incentive to conduct fraud, such as personal financial issues, whether it's a gambling addiction, medical bills that they just can't pay. That the financial structure has puts the pressure on them, in order to the pressure to get more money. The second side is the opportunity side. This will be the lack of controls, the lack of the override of controls that the fraudster is able to do in order to orchestrate their schemes. And the third side is the rationalization. So this is the fraudster convincing themselves that it is okay what they're doing. I earned the money, or if they make profit, then so should I. I deserve the money. So these are all, things that the fraudster will say to themselves to rationalize why what they're doing is okay. If I go to the next slide, the Association of Fraud Examiners conducts an occupational fraud study every 2 years. So the one for 2024, it's every even year. So 2024 is an even year. So the occupational fraud study came out about 4 or 5 months ago for 2024. So we are showing here the occupational fraud categories: asset misappropriation, corruption, and financial statement fraud, and how it compared in 2022 to the most recent report in 2024. And as you can see, occupational fraud has increased from 2022 to 2024 based off the ACFE's study. To give a little quick background on the three different categories of occupational fraud, the first one is asset misappropriation, which is an employee stealing or misusing the employer's resources. Per the ACFE study, this is the most common, but also the lowest medium loss, so the least costly. Think of it as theft of company cash, so incoming payments are stolen from an organization, fraudulent disbursements, things of that nature. It could also be non-cash misappropriation. So think of it as a personal use of a business vehicle. So it's not a cash use, but it is a misuse of a company resource. The middle category that went up $50,000 as the medium loss went up $50,000 year over year from 2022 to 2024 is corruption. So corruption involves an employee that misuses their influence in a business transaction in a way that violates their duty to the employer in order to gain some kind of benefit, some kind of advantage. Per the ACFE study, this is the middle on the frequency scale of cost, as well as the other ones. It also went up year over year. This is your conflicts of interest, your purchasing schemes, your bribery schemes, situation where employees have too much control over relationships. And the last category is financial statement fraud. This is, according to the ACFE, the most costly, but also happens the least. These are the more sophisticated financial statement schemes, the overstatement or understatement of revenue, fictitious revenue, concealed liabilities and expenses, things of that nature, that causes a material misstatement or an omission in the company's financial statements. So with that quick overview of occupational fraud and the fraud triangle, to get into the first case study that we've worked on in the past year, the first organization was a medical practice. And to set the stage a little bit, the medical practice saw many patients during the day. They collected insurance co-payments on a daily basis in the format of cash, credit cards, checks. And for the cash that was incoming into the organization held what they called a cash box. So at the start of every day, $200 would sit in the cash box. Money would come in throughout the day. And at the end of the day, they would reconcile and close out the cash box, leaving $200 in the cash box for the next day. The cash that was collected during the day was to be brought to the bank for deposit. So we were engaged to help investigate and quantify potential asset misappropriation through various schemes. And the reason we were brought in was because the fraudster did admit to the organization that he was performing some scheme. There was some restitution payment back, specifically related to a payroll fraud scheme that he committed. But when the owner of the company started looking further into the financials, and we'll get into in a little bit exactly what she looked into, she saw some other nefarious activity, some other activity that just did not make sense to her. And then she started her own individual independent investigation. And then we were brought in as well to help with that investigation. So the allegations that were identified during this independent investigation was the potential for theft of cash, use of the American Express credit card for unauthorized purchases, as well as fictitious companies were created to divert revenue away from the company. The first the forensic services that we deployed was first thing is to develop a work plan. We held discussions with the owner. We interviewed people at the organization, and that was more so to help understand the roles and the responsibilities of the potential fraudster, what they had access to help plan further as to what exactly we need to be looking into. We came to understand from these interviews that the fraudster was in charge of pretty much everything. He had full blown control over the bank statements, over the general ledger, over the QuickBooks, and he was ultimately responsible for making the banking deposits at the bank. We performed a background investigation to help identify related parties, related entities, in order to understand what other entities did they have access to help with the diversion of revenue, allegation, and potential other misappropriation. And from that information, we developed a work plan to kick off the investigation. The cash copays, we obtained from the company a listing of daily cash receipts from their patients. We analyzed bank statement activity to understand what actually went into the bank account, and then we reconciled to identify what was missing from the listings to the bank statements. From the American Express perspective, we obtained the credit cards and we did a reconciliation to understand what was paid out of the company versus what was paid out of the company against company cards, and what payments are then unauthorized and unexplained. And from a revenue diversion perspective, we analyzed age receivables to try to understand potential diversion, and then identified potential contacts at vendors to contact to understand whether the payments were made or not. And lastly, the findings and the results from this investigation was that the fraudster was trusted to perform many roles. His trust went unchecked. The cash control procedures were not monitored. There was inadequate cash control procedures. There was no segregation of duties, no oversight in the cash control function. Although the cash was maintained and counted, the door was open for theft. The cash disbursement procedures lacked internal controls and oversight, which allowed the unauthorized payments to be made to American Express. And the revenue, the diversion of revenue is still open today. We're in the process of quantifying the impact there. And I'll pass it off to Jess to talk about case study number 2.
Great, thank you, Justin. And I'm going to switch gears for a moment, kind of away from the for-profit entity like the one that Justin just talked about. And I'm going to delve into an engagement we handled this year for a large national trade association. And in this situation, similar to many trade associations, the organization was relying on a contracted executive director who handled not only logistics of annual meetings, the communications to members, but was also fully responsible for the accounting side of the house. This was a longstanding executive director, had over 10 years of tenure at the organization, and was very much both likened and trusted by the board. The board believed that they were fully up to speed on the finances of the organization because the director would present and discuss those financial results on a regular basis at the board meetings. Fast forward a little bit, and the organization had some turnover. A new on the board, a new treasurer stepped in, and in addition to these regular monthly reports that were being presented to the board, that treasurer requested some more detailed financial information, such as copies of bank statements, bank reconciliations, general ledgers, just some of the more basic accounting documents. And that request was initially met with some hostility from the executive director. So red flag number one. And it then took a significant amount of time for him to produce those records, which to the organization became their second red flag. And then upon the receipt of that information and the treasurer starting to take a look, there were some transactions which she flagged and questioned with the ED, to which she felt she got failed to get appropriate responses to. So that was really the third red flag to them. And it was at that time that the organization decided they should really bring in a forensic team to investigate some of these items that the treasurer was seeing. So at that point, we stepped in, and the organization asked the executive director to hand over all of the financial records of the organization, along with the laptop that he had been issued and utilized as part of his duties with them. That was initially met with a promise of cooperation that ended up being really anything but that. And Justin, if you can just skip to the next slide. The records we ended up receiving from the director were spotty at best. And when we did finally receive the organization issued laptop, it had unfortunately just undergone a factory reset, which appeared to be an attempt to eliminate or erase a lot of the documents that were in the possession of the executive director and that he had accessed on his laptop. So the first thing that we did here, similar to the case Justin just talked about, was a background investigation. So just to give you some background on a background investigation, our team here at Withum, we have several private investigators who are also former FBI. And as part of this kind of background check, we asked them to go in and identify any family and related parties of the executive director, as well as perform a social media search on him and his family. And this ended up being very important in this case, as that investigation and those social media searches really gave us some information that became pertinent as we began to go through our analysis. Um, First, it identified other nonprofit organizations that this individual was associated with. And on top of that, the social media searches gave us some dates and locations, kind of a timeline of this individual's lifestyle, where he or she were at different points in time. And you'll see later when I kind of talk about the results and the analysis we dug into, this ended up being a very important part of the investigation. The second imperative piece was the use of our Withum cyber team. So here at Withum, we have a team of digital forensics experts, and what they were able to do, if you remember, I mentioned the laptop had been factory reset with an attempt to, what we believe was an attempt to wipe clear some of the documents that he would not want us to see. So what our digital forensics team was able to do is take that quote unquote wiped out laptop, and they were able to recover a lot of the deleted content that was included on that laptop, and that ended up being really important as we went through our analysis as well. So kind of with that background investigation in hand, the recovery of the deleted content in hand, we then started to dig into the our analysis of the financial records, and we were able to start looking at kind of this what I'll call general ledger reporting that previously had been provided to the board and then subsequently also provided to the treasurer upon her inquiry. And we began to cross-reference what was being reported to the board in those reports to those the deleted content and the bank statements that we were able to get. And what we revealed in that analysis is that those general ledger reports and the reports that had been provided to the board had been manipulated to disguise many of the transactions to be something that they weren't. So Justin, if you skip to the next slide, I'm going to talk a little bit about the findings, right? And I talked about the disguised payments that were made to appear that they were something they're not. So in the general ledger, if you were to look at the document that had been provided, it had appeared payments were being made to valid vendors. Anybody that looked at that reporting would not have known who the transactions actually went to. But in actuality, when we started digging into the bank statements and the other information that we had available, what we found was that over $350,000 of funds that had been disguised to look like they were going elsewhere were actually direct payments to the executive director himself. And those were payments that he disguised as his contracted payments, as well as quote unquote reimbursements for certain expenses. But what we found later were those expenses had already been directly paid for by the organization. The second item that we found, and this we really contribute back to those social media searches, were that many of the hotel, travel, entertainment type expenses that in these general ledgers appeared on their face that they could be related to organization meetings, because the organization had in fact previously had meetings in or around those locations, ended up being personal travel and family vacations of the executive director. And we were able to kind of piece together that those specific expenses were actually related to the executive director and his family based on this timeline of dates and pictures that had been posted to various social media accounts of friends and family. And then our last finding, if you recall, I mentioned during our background investigation that we identified that the executive director was associated with another nonprofit. And during our analysis, we identified a significant amount of payments to the tune of $225,000 that were going from our client organization to this other nonprofit organization. And somebody may ask, well, why would they do that, and how is that a diversion of funds? But ultimately, we ended up being retained by that other organization as well. And what was occurring was that there was theft and embezzlement occurring at both of these organizations. Our client being the bigger of the two, so the movement of funds was really an attempt to cover up and make sure that this other entity had enough funds available to fund its expenses. So in total, we found over $650,000 of funds that were embezzled from this organization by the executive director. So clearly, in both of the investigations, the one that Justin talked about and the nonprofit that I just spoke about, there were control deficiencies that allowed there to be an opportunity for the fraudster to perpetrate these frauds. And one of the things that I like to point out about the fraud triangle, and Justin went through it before, the three sides, the rationalization, the financial pressure, and the opportunity. But when you think about the triangle and you have the rationalization and to the greater extent the financial pressure sides, those factors more often than not are associated with personal lives or something outside of the organization. But when you look at that bottom bar that's holding those sides together, the opportunity, and the opportunity is really the main area of focus when we talk to organizations and companies about how to protect themselves through implementation of internal controls, because that's really the factor of the fraud triangle that can be most controlled by companies. So the biggest thing that we found in these specific engagements, and honestly is quite often the underlying issue in many of our investigations, is a lack of segregation of duties at either the for-profit or the nonprofit. And in this instance, it was also paired with a lack of oversight of the controls that were in place. So each of these entities did, in fact, have controls in place, but as you can tell from the results, the controls are only as good as the implementation of those controls. So as an example, in the first case study that Justin spoke about, there were in fact controls in place to ensure cash was being accounted for by more than one person. When cash was received, it was put onto a cash log by the um, person at the front desk. It was later logged into the billing system by somebody else, and then there was to be this third person that was going to go and make the cash deposits. So the appropriate controls in fact existed, but the end problem was that nobody was actually overseeing that process. Nobody was actually doing the reconciliation to ensure that the cash that's been posted to the cash log matched the cash that was deposited to pursuant to the billing records, and ultimately matched the cash that went into the bank. So I'm going to kick it over to Justin, and he's going to chat about some of the fraud prevention strategies that companies can utilize to help reduce the risks of something like this from occurring.
Thank you, Jessica. So very quickly, I know we are running out of time. Some fraud prevention strategies to help reduce the opportunity for employees to orchestrate schemes against their employer. Employ active detection methods. These are processes in place or efforts designed to proactively detect the fraud versus passively detecting it and finding out after it's already being orchestrated against your organization. So examples include document examinations, involved management review on things, internal audit departments, reconciliations, and IT specific controls. These methods will reduce the duration of a fraud scheme and lead to reduced losses. The second box over here, proactive fraud control. Some examples of proactive fraud control include code of conducts, creates an anti-fraud culture within the organization, a hotline or a whistleblower program that allows tips to come in. Are there options given to employees about reporting what they observe? If there is wrongdoing going on in the organization and you want to know about it, organizations should provide their employees an opportunity to blow the whistle on such activity. Again, internal audit departments could be proactive fraud controls, as well as regular management review of controls, especially in an ever evolving COVID world with technology changing. Internal controls should shift with the times. The box at the bottom, outsource business functions. So this allows disbursement functions to be outsourced. So it's not your internal people working on it. So it doesn't allow the opportunity, especially in small organizations where you're probably going to have one or two people in your accounting department, outsourcing certain functions such as the bookkeeping to Withum's Oasis group or things of that nature. Or internal control assessments. Withum has an internal control assessment group as well that can do robust internal control assessments on processes to understand where the gaps are. So to outsource such functions allows to not have that segregation of duty issue. And lastly, the tone at the top speaks for itself. If management at the top is acting one way, the employees are going to follow. So if management is acting bad, their employees will act bad. If management is acting good, employees will act good. It's all about the culture at the end of the day. And if the culture of the organization is a culture of fraud prevention and understanding the issues and not encouraging this activity, then the tone at the top matters. With that, if you have any questions, feel free to contact either myself or Jessica. We're happy to answer any questions you may have.